We have with us Chairman of Satacom Health, Mr. Ang Hao Yao, the Head of Corporate Governance at Aberdeen Asset Management, Dr. David Smith, and Partner and Head of General Assurance PricewaterhouseCoopers, Mr. Marcus Lam. Give him a round of applause. A couple of quick questions. First of all, who here is with an organisation that actually has surplus funds?
They're too shy to identify.
Let me try that again. Who here has surplus funds? Okay, maybe the reverse might be an easier question. Who here does not have any surplus funds? Raise your hands, but would like some. Okay. And the rest of you are just here for lunch, Hello? Is it? I'm assuming there are some people who are too shy. And that's probably partly because of the subject we're talking about. You don't want to make yourself liable, am I right? Well, let's quickly turn our attention to the app once more. I have two more questions here for you to kickstart our conversation here on stage. Let's get the first of the app questions up. How much profit should charities make from surplus funds? And Professor Ho, you just addressed the issue of the philosophical question, should we be making any money? How much profit should charities make from surplus funds? Here are your 5 options. As much as possible with returns reinvested, compound interest, all of that stuff. Yes, as much as possible, but with the returns spent only on services, back into the current account. Not too much, because we don't want to become too focused on generating profits, as you said, Professor Ho. None, after all, we are not for profit. Or we should be rag and bone. No surplus funds. That would go against our principles. Use the app to vote now. Not too much, because we don't want to be distracted. It looks like they were listening to you, Professor Ho. But we're kind of overweight on the as much as possible front. Can you first help us get over any pangs of conscience that we have, Professor Ho, about generating returns, that 4th income stream that you talked about?
Okay. Right. So I'm going to introduce to you the concept of stewardship as it is. I think if we see charities as nothing more than steward, then as steward, we have a responsibility. In that sense, we don't own the resources. Right? So as a steward, our responsibility, therefore, is to maximize or at least to use those resources to the best of the cause that we have been called to. Right? So in that sense, I believe very strongly in the sense that whatever you are given, you'll be held responsible. Right? In that sense. And the fact that you have been having so much resources or reserves or supplies is because you are good. And then the challenge for you is that how can I even be better? Because now that people entrust me with those resources because I'm good. And you want to make those resources your slaves, is what I mean. But without taking unnecessary risks. So the stewardship function requires us to take calculated risks for the sake of the cause in which we are called to champion, is it?
Marcus, would you agree that you shouldn't just anyhow leave it in fixed D? Because, I mean, apart from not keeping up with inflation, you are, as one of our guests here said earlier on, you're abrogating your responsibility to both donors and beneficiaries by not trying to, do as much as you can with them.
I guess after the half an hour presentation by Prof, I'm convinced that I would do the right thing by learning from him. I sit on a small board, which is Parkinson's Society, and I confess I don't have as much surplus fund, and the funds probably last about 3 years in max. But I think coming back to your point, I think it's a must for us to really to do our best for the charity and the society, and to make sure that the resources that are available there are well taken care of. I think I just have a few points to add. One thing that really struck me is that if I could ask people in here, do you do financial planning yourself? Do you?
You mean for personal finances?
Yeah. Are you good in financial planning?
Hang on, those are 2 different questions. Yeah. Who here has a financial planner? Who here, beyond your CPF, you actually do some financial planning? Okay, for everybody else, on your way out, please sign up for financial planning for families at the registration counter. But your point of this question is?
Yeah, the point of this question is really coming back to financial planning for yourself. In itself, is not an easy task. So think about the funds that you have in the charity. In the same way, you're entrusted with the stewardship function. In your own financial planning, you have difficulty. And how would you be able to do that for a charity? So very simply, if you want to discharge, it's a must to get the right people and the right expertise. Then you'll do it right for the charity.
But what happens if, such as your own association, focusing on Parkinson's, I suspect that there are lots of people in the room who wish they had this problem of investing. So maybe they just don't have surplus funds. Is this a valid excuse to say, hey, you know, we don't have any surplus cash anyway. We don't need to focus on this too much?
I guess the question of surplus fund is how much of a surplus fund. And I think it's incumbent upon the charity to decide that how much of a surplus fund is available for investment. I think it's clear for ourselves by looking at, typically you should have, from my ideas, that at least 3 years enough to cover your expenditure to make sure that the charity can function as it is. I think beyond that, if you have any amount that's beyond that, I think it's critical for you to look at what are returns you can get. By not looking at it, you're just avoiding the issue. And I think if you once the board has agreed that beyond that amount, it's something that will be good for the charity, I think you got to take a critical decision on it.
The reason I asked this question is because when you asked how many people here do financial planning for themselves, one of the mantras, and you'll see this in the CPF adverts at the moment, you know the guy dressed in the squirrel? You've seen the ads, right? The theory behind personal financial planning is that you must plan even if you don't think you're rich, right? Even if you don't think you have money, you're never going to get any unless you plan. Doesn't the same apply to charities?
It does, which is why I started by saying really about financial planning is if you apply it to yourself, you apply it to the charity that you sit on, I think you would take an active discussion with the board about what you can do on that.
Okay. Yeah. Oh yeah, earlier on Professor Ho shared your surplus, 70-something million, if I remember correctly. Is that enough? At what point did you draw the line at Satacom Health to say...
Okay. If you have more than enough, you can redistribute among here.
I think we'd need to get some clarification whether such a donation from a charity to a charity is tax deductible. But, Hao Yao, at what point did you say, hey, you know, we now have so much surplus cash that we've really got to get serious about it? What is that? Is there a magic number?
Well, we've already been investing it for a long time, I think more than 10 years, so it wasn't something that is set from year to year or set by the current board. However, well, we only invest about 50-odd million. The rest are fixed assets and such.
So you only invest 50-odd million?
Yeah, of the 70, yeah.
Okay, that's good to know.
Yeah. Well, we try to not collect donations, try to be self-sustaining. So that's why investing our money is very important. It has to generate a return and to help support our programs and operations. I think the question was actually how much should, or what kind of returns should one expect, right?
How much is enough was in essence the question.
How much is that? Well, I have a slightly different point of view. I think in the financial markets, you really have to make as much as you can, but based on the amount of risk you're willing to take. I sit on a few boards, and I think most boards would like to say, that, and they do say, that they want their capital to be protected or guaranteed, but yet they want to outperform fixed deposit rates, SIBOR rates, and so forth. So that's like asking to have your cake and eat it too, right? But I think going through some of the fund offerings by the fund managers, I think there are funds that for example, short-term bond funds that can provide a couple of percent return. I've come across about 3% return annually that can be earned on somewhat safe investment-grade bonds. I think a fund manager can elaborate further on this. But if the charity feels, okay, I have enough surplus and I'm willing to tolerate a volatility of, say, 5 or 10% from year-to-year basis, then you can start thinking about equities or exchange-traded funds, mixture of bonds or even gold can be considered. But you have to accept some kind of volatility. For example, for SATA, our return, I reckon, has been about 5% or just over 5% for the last 10 years, 5% per year. And it's something we feel is a long-term structure. And I'm glad the board actually went forward to invest the funds more than a decade ago, because if we hadn't, and we had only put the money in fixed deposit over the last 10 years, we would have over 40% less reserves today, and therefore we would have much less to contribute to our programs and services. So I'm pretty glad that the board has gone about, and I think Dr. Ho was on the board then, and so thanks to Dr. Ho as well.
No wonder he had the numbers. Professor Ho.
I think at one point in time, Hao Yao was my chairman as it is. Both of us actually toggle in terms of our role. I was the chairman of AC, then he was the chairman of investment. Then when he became the chairman, then we switched over portfolio as it is, right? So we served together for many years, and I think, to be fair to, we have a very courageous board. Our predecessor was very good. I served with long-time people like Robert Yao and all the oldies of the landscape as it is, and they have a very stable pair of hands, very enlightened. They put on for us a framework in terms of investments, concerning what percentage of it is fixed income, what percentage of it is in bonds as it is. And with the board's approval and also with the investment committee, I think we were able to systematically actually generate the returns. If you look carefully at SATA's financial statements, you realize very clearly that every year we run deficits. And it is actually our investment income that augment our deficit. And at some point in time in our decision, SATA, we gave our IPC status. We felt that there's no reason for us to continue to collect money on the IPC status and draw the funds away from other charity. It was a significant move because we can't justify that position as it is with that kind of reserves that we have, you see. Right? So you may ask, so I think maybe this is what I would like to suggest, this is what charity would like to think about. Given the blessings that we have, at some point in time, let us rechannel them to the rest of the charity that needs it, you see. Right? And okay. One more thing is that at one point in time, we almost went belly up because we asked ourselves, since there's no more tuberculosis, should we close down SATA? And distribute our funds to other people? When we think about that, our founder will roll in their grave, so we better not. And we reinvent ourselves as it is.
Let me pick you up on a couple of points there. First of all, you said that ideally you appoint somebody who supervises the fund manager. But just now I thought, maybe I misheard, I thought you said that you actually had somebody internally who supervised, yes, or internally who managed.
The investment committee makes up a you see, we are very fortunate. We have very fine financial professionals, and Hao Yao through his network has brought in very good, excellent people who give of their time and skills. So their task is to supervise a fund manager to ensure that the fund manager delivers on their promises.
Okay, and again, I want to make sure that, again, all of our guests here today walk out of that door with some concrete action plans. For most of you here, I suspect you're nowhere near the 70 million that Satacom Health has, and I think there were some others who had even more. But the question, of course, is how do you get there? We've already had Marcus's contribution that you need to get yourself a planner, somebody who can help you devise a plan. And Hao Yao, you've already contributed that you had a 5% return benchmark, or was that happened to be the outcome? Is the message therefore, don't aim low, have a plan, have a number that you can benchmark yourself to? Is that the message?
Well, I think the message that I was trying to give was that first you have to establish the amount of risk you're willing to take. Because if you're not willing to take any risk or much risk, then the return isn't going to be very high.
But we had Wintech say in the first panel earlier on, you're all way too risk averse. Risk avoidance, transference, mitigation, nobody wants to take ownership. So how do we know what is an appropriate level of risk?
I think maybe I want to encourage all of us to say, actually, I have studied the Singapore charity sectors. I think very few charities actually runs at the deficit in Singapore, right? You see, the reason is very simple. I think we have to be very clear in our mind. So long as we are doing very, very good works in the charity, efficiently, effectively, I would like to suggest actually the money will come in, right? Because when the beneficiaries actually get benefit from the charity as it is, the donors will actually pour into charity that are well run, you see. And that is why many charities over the years, through your surplus, actually you snowball your resources. I can't think of too many charities, actually you can tell me in the last 5 years you run deficit. If you do run deficit for the last 5 years, actually your existence is threatened, right? So that means by definition, most if not all well-run charity over the years will accumulate some form of surplus because you can never finish spending whatever the money that's come in to do your work as it is.
Okay, I already asked that question and we got no hands up, so I'm not so sure. I hear the vibe is that actually there are a lot of charities that are struggling, and partly also because the professionals who you talked about, the ones who you got to bring on board, the ones you have to hire to help you with your financial plan, to write that IPS, the investment policy statement, they also cost money. So can you again just give us a concrete step-by-step how-to in order to get to a position where we have a surplus, no matter what the starting point is? What are the things to do and not to do? Where should we be spending the money? Where should we be saving the money?
Well, I guess the first starting point is always our financial plans as it is, right? I always, when we were together in SATA or even in the charities I sit on, we always try to get the finance manager to give us 3 to 5 years forecast. Because see, the thing is that we are not fly by night, We really want to do continuous good works as it is. We need to know where are the funding gaps as it is. Do we need to talk to the government more? Do we need to raise more money? Do we need to increase our cost recovery in terms of our services provided? So the first starting point will always be from your finance manager to help you put in place a financial plans. Survival comes first, thereafter you talk about shoring up your reserves, and then you talk about investing your reserves. So it's almost like a sequential steps that you're trying to do. If you don't have a financial plans, then unfortunately everything will be hand to mouth, is it? Right? And it's an ad hoc, year-by-year existence for that matter.
Okay, and before I finally allow David to speak, Hao Yao, if you're in that happy, problematic situation where you have significant surplus funds, how do you avoid the situation which Professor Ho talked about earlier, where it becomes kind of all-consuming, that you're actually much more there to manage the surplus funds than to do good? How do you prevent, that tipping point, I suppose?
You mean taking away time from
spending too much time, yes, on the investments?
Well, you have to allocate your time appropriately, and you have these professionals that sit in the IC who will specifically look at funds. So it doesn't take away time from the rest of the volunteers. Just on that point, I'm not trying to say that everybody should quickly set up an IC and go and invest, because I think there's a lot more resources and time that's required than people think. For example, aside from just your IC or your board's time, you also take away management's time, there's accounting for it, there is internal audits, there are external audits, and even time to explain to your members and stakeholders. So there's a lot of resources really, and if the amount of reserves that you invest and the kind of returns that you get may not be commensurate with all the opportunity cost of this time. So these are the things you also have to consider.
Okay, as we lead into David's contribution talking about asset allocation, a quick poll, the final poll for this morning. And this one really pertains to where you should be investing your surplus funds. Should they be low risk, as a little nod to Tae Woon Tek's presentation earlier? Should they be somewhat higher risk, such as equities? Should you go all out and say, we no longer want government subsidies, we don't want to have to collect donations, we're going to go for derivatives. We're going to go for whatever we can to get the out-of-this-world returns. Should you restrict yourself to property? And Hao Yao, you mentioned that about 20 million out of your funds seem to be invested in property. Or should the charities be permitted to choose whatever their committee wants? So let's see your answers through the app. Okay, give you a couple more moments. Yeah. No votes for derivatives just yet. On behalf of China Aviation Oil shareholders, I'm very happy to see that. Okay, any final votes? David, it looks like we've all taken the presentations earlier today to heart. Avoid risk and stay with something that's relatively safe. What are your reactions?
It's a pretty broad topic to discuss in a few minutes, but well, firstly, I'd just endorse what we heard earlier about the process. It's incredibly important that the right process is in place, that there's the right people that are involved. Even if a board forms an investment committee, the investment committee needs to make sure that the right people are advising that committee, whether it's an advisory board or consultants that can advise on that. Now, once you've worked out your budget and your surplus, your shortfall, and you've stressed your contributions, for example, then you come down to risk appetite. How much liquidity do we need in what time period, and how much risk can we take? Now, that decision takes some discussion as well, because people's natural tendency is to say, I want zero risk, or I want sort of quixotic, guaranteed principal, but 7% return. And if you can find that, then please let me know. So that discussion of how much risk can be taken is also should be two-way as well, because if a charity or any entity, whether it's a company board or a statutory board or even your private wealth, if you have a lot of money relative to your immediate needs, and immediate could be 3 year, then you can take a little bit more risk. We should remember that there's varying levels of risk. There's not risk-free. If you look at fixed income or government bonds, for example, we're talking some markets, negative yielding government bonds as well. You've got currency risk on some of these investments. But if you can look at your portfolio and say, well, maybe we can take a little bit more risk here, then we'll have a little bit in fixed income and a little bit in equities. And then maybe someone decides, well, maybe we'll put a little bit in property as well. But that discussion to reach that asset allocation and risk appetite is quite important. But also around the board and investment committee's expectations of return and also expectations of volatility. I mean, we heard earlier this year that the drawdown in Q1 this year is about 12%, and it's a tendency of people when faced with those kind of market conditions to say, dear God, we're going to lose everything, let's take everything out of the market. In many instances, that can be the worst thing to do. We saw that the best returns over the last few years were putting money in 2009, and that's when the market's in a terrible condition, putting more money in. Now, those kind of, sort of contrarian or counterintuitive decisions don't come naturally to
Yes,
individuals.
because the emotion always gets involved. And the funny thing is that when you go to the bank branch to do a transaction, and the officer behind the counter wanting to serve you, the only time when they try to sell you capital protected funds is when the markets can't go any lower anyway. So not much point. And as you say, you should probably invest it when the market's at the bottom. So we got from you a couple of points. one, have a plan. 2, assess your risk. How do you actually go about doing that?
Well, there's many ways of measuring risk, and one of the things that Hao mentioned was volatility, and you also psychologically need to look at maximum drawdown, also for your financial planning as well. So, if your contributions dry up for 2 years and the market is down by 50%, then what does that mean for your balance sheet and P&L, for example? But there's various ways to look at risk. One thing I did want to pick up on earlier was the amount of time that needs to be contributed to this. I think if a finance team which has put money out to external fund managers is looking at the market every day, then something's a little bit concerning. I think there needs to be an understanding that if you put money out to an external manager, then there should be a reasonable interval at which to meet up with fund managers. That's not to say that we don't want to hear from you for 3 years. It is your money that we're managing, but there has to be an expectation that the markets move around on a daily, weekly basis, and so 3-month, 6-month, yearly catch-up with fund managers are important, and that sometimes the market moves up, sometimes the market moves down. But this shouldn't be an issue that takes up 3/4 of a board's discussion, I think, particularly if you're putting money out to an external manager.
Okay. Yes.
So what I want to do is I want to make a suggestion and introduce a concept called the spend ratio. You see, once your finance manager draft out the financial statements and projection for the future, you will know what is your funding gap. Let's assume your funding gap is X thousands of dollars. And in order to plug that funding gap, you require your fund to generate at least 3% to cover that. See, that immediately becomes a possible target. You understand what I'm saying? Right? It could be 2%. So what you do in this instance is the fact that you having computed what is your need as it is, you set as a target, and you go back to the investment committee and say, right, every year we need to draw down 3% returns from the fund as it is. So 3% becomes our minimum. So then the investment committee will say, all right, our spend ratio policy is 3%. And they'll go back and say, all right, we can take a tolerance to say, let's set a target of 4% returns. We save 1%, 3% we spend, we save 1% as it is. Right? And then the fund manager will say, all right, given the fact you have 4% returns and whatever, this is the investment strategy. 60% fixed income, 40% equity. Alternatively, 80% fixed income, 20% equity. So by telling them what do you want to have, they are supposed to calibrate the investment strategy to allow you to fulfill your job. So whatever the market goes up, goes down, you discipline manner-wise, you spend 3%. Right? When you earn more, you shore them away. But when you earn only 1%, you can still spend 3% because you have reserves that has been squirreled away. So this is what is so-called the spend ratio concept. You see. And this will give you financial stability in your charity, because now you can count on that 3% or 2% year on year to help you to augment your charities to do more interesting work. You see.
Just on this point, I think I want to just to share that I think quite a majority of charity sector do have funding issue. Really, I think I meant that as that some charity, they really have to go out and seek donation. They have to do fundraising, and that's quite a fair bit of effort. So it's a true fact in the charity sector, and so there are obviously certain charities that attract funding by virtue of the things, good work they do, but there are some smaller charities that start up and continue to struggle trying to attract the right attention. But that doesn't mean that we don't do something about it. But I do feel that, coming back to the point that all shared, that the decision of how much you're going to set up a fund, it's a very major decision. And we should not go into it just simply because you think you have a surplus fund. I think it should be a robust discussion at the board with the right people, that means with investment professional, guiding you on what you should think about. I'm saying it's simply for us to just share some of this, but really the first thought process is really the board got to be on board of this with the right people, think about what you can do, and if you cannot even do a proper financial projection of your needs for the next 3 years, I feel you have difficulty trying to invest. You really have. If your finance team and your resource cannot do that, you're not in a position to discuss on this. So I think you got to get that level of expertise up, get a board to talk about it, get the investment people to educate you, and then obviously be able to set up that properly. Yeah.
I always worry when I hear words like good and right, because everybody has a different impression of what that means. Can I pinpoint this, and Hao-Yao, for you to answer as well? Does the right person necessarily mean somebody who collects a fee for their advice as opposed to somebody who collects commission on the sale of financial products?
Well, Well, typically fund managers earn an annual.
I'm talking about at the charity end, before we even talk about the 1.5%, 2% or whatever that the fund manager charges.
No, I think the IC is all volunteers typically, so we don't.
Marcus was just saying you've got to get the right person on board to advise you in a disciplined, non-emotive way. Should that person be paid a fee, or should you just, ring up an insurance company, with a nod to you, Marcus, and say, hey, come on in and talk to us about investments? I mean, you'll see dollar signs in their eyes, right?
No, I think you can get a lot of good investment professionals to give you pro bono advice on this. Yeah, so I don't really think that they pay a consultant fee for that, but say I've not seen that in any case. Yeah. Usually we have an IC, and then the IC can give you enough advice and to set all this up before the beauty parade starts for the fund managers.
Okay, quick show of hands. Who here actually has such a financial advisor in your charity at the moment? Maybe it's you. Who here has such a financial advisor? Professional, maybe pro bono, maybe paid in your organization? Who here doesn't? Majority. So, how do you interview such a person? Again, because you can find any number of people who will pass you their name cards at a party and say, I'm your financial advisor. So how do you pick them?
Okay. I think we have to be clear in that sense. Most of the time, in fact, I can't remember any charity has a paid financial advisors on the charity. I don't remember having it. You see, I think the challenge is always for us to get a network of friends. You see what I mean? Of course, we always have this standard joke, those who put up their hands, you don't want them, thanks and no thanks. Right? Those who are really good, we want to get the job done, you're going to look for them. So again, I think there needs to be two possibilities. One, I think those who are financially trained, my plea has always been serve the community. Use part of your time. It doesn't take a lot of time. Investment company probably meets 4 times a year, each time 2 hours. Then you get a chairman to buy you lunch, as it is, right? So I think it's not too onerous as it is, because unless you're talking about mega millions, most of the time the decisions are small decisions. It's a drop of the bucket based on the work that you are doing. I think the other second thing is that, again, this is where the board composition becomes extremely important, right? If you have a board composition, if you don't have someone there who is financially skilled, then one piece of your board is missing, You see what I mean? Right? Of course, you may say, but my charity is so small, nobody wants, But you will have to grow over time. There are well-intended people there. You just have to make the connection. And I want to encourage many of you who serve don't just only serve on the big charities. They are glamorous as it is. They are great as it is. And actually, the risk is very low because they have all the structures and resources to protect you. But maybe one possible resources is to serve on a smaller charity and help them to move up the ladder, and also bringing your friends, right? And that's why in the slides I have, I call it the seasons of an IC member. All of us as board members must always have a season. That means we cannot be there forever and ever. We must be a season, 5 years, 6 years, 10 years, and thereafter we must bring in our friends and network who will replace us and do a much better job.
Okay, yeah, Marcus.
Yeah, I think just to add on this point, I think as a board, really having diverse skills are very important. And so whoever sits on the board, I think it's important that if you brought on the board, it's really to think about what are the diverse skills that you can bring on the board. And so obviously financial investment planning is one of those skills. And so it's then really, if you start right at the board, and the board sets out for itself that apart from getting people that are committed to the cause, getting people with diverse skills, once you set on doing that, I think year after year, sooner or later, I'm very sure you get the skills. Yeah.
In the defense of our audience here, half the time, isn't the problem that you can't find board members of any sort? Isn't the problem that you've had people who've been there for 30 years, and it's not that they don't want to go, it's that they can't. There's no successor. Is that about right? So how do we get more financial experts, apart from Robson, who's already volunteered his time, to sit on boards? What's the secret ingredient? Hao Yao, you obviously also have on-the-ground experience. What did your board do to bring that renewal about?
Well, I think first you got to show that I think going back to the earlier panel, in fact, they say that you have to show that your organization and your board is serious about corporate governance in governance in general, and that they have professional people already on board as well, and to be transparent and follow the code of governance for charities.
Should you hire an executive search firm? No. Should
no,
you ask your
don't really
golfing
have to.
buddies?
Because I think as long as...
Where do you find them?
You see, when you ask somebody to be on a board, the first thing they're going to do is pick up your annual report. They're going to your website. They're going to see if you have been, perhaps even your governance checklist and so forth. And they want to see, that the organization has been run well. That's first. If not, they may just tell you an answer, oh, I'm busy. But really, because they looked at your financial statements and really there's little transparency there. So that's one. And second, of course, you can go to NVPC, board match, and so forth, and ask around. Not forgetting that soon there's going to be a guideline on the renewal of board members of this 10-year limit. And so I think there may be some movement around, and I think that's the opportunity to pick up some new board members.
If he hasn't answered your question, ask him again at lunch. I need to move on, though, to the topic of volatility, because your charts, Professor Ho, also show that clearly financial markets can go up and down. Even the bond chart you had, we had 8 out of 10 of you say that you would prefer to invest in bonds, or bonds is the right sort of asset class for charity. But they also fluctuate. How do you now explain this to your donors? What is the practical, can implement tomorrow morning sort of advice that you have for explaining to your donors and possibly also beneficiaries as to why there was that volatility and whether you're still fully in control?
So actually, this is probably one of the greatest challenges that charity face, because we have come across situation when the markets falls, the trustees are so concerned, so they pour all their money. Once you pour your money, you will never recover. You know what I mean? So in that sense, that's why I say the robust process has to be there. In that sense, you need to have strong hearts, steady hands, right? You need to educate your stakeholders. Look, investment, there is no sure returns on investment. And the day that you have decided to enter into investment, you must live with the consequences that there will be up times, there will be down times. The only thing that we can promise you is that we will try to contain the downtime as it is. And if it's down, we will hopefully hold it long enough in the long term that the downtime will recover. That is the only promise that we can give you. See. Otherwise, I can't, because I don't know what the future. I can only convince you with my sincerity, with my competencies, with my professionalism. Right? I mean, and if you think that's not good enough, then you have to replace me. Right? Yeah. I think that's all we can sell. Yeah.
You would have seen some volatility if you've been investing at Sata Comhealth for the last 10 years. 2009 would have been a great one for you.
Yeah, well, I mean, the very reason we invest is because we feel that the future is going to be better than the present. If not, then you can't invest in the future, right? As for our experience, in the last 10 years, obviously, there has been financial crises and so forth. And I looked back and I saw that we lost money in 3 of 10 years. But if we hadn't invested prior to the financial crisis, we wouldn't have had the gains. And also any losses that came about as a financial crisis, I think we lost over 10% of our portfolio, was all recovered in the next 1 or 2 years. So you must have a very long-term horizon before you can invest. If not, you're going to have heart attack. And worse off, your stakeholders will come and shout at you or your board members and say, we just cut loss now. And as you said, that may be the worst time to do so. Perhaps it may be even a time to invest more. Right? And that's the way financial markets work.
Yes. So strong hands, strong heart, and strong stomach. David, obviously when you then negotiate your portfolio, as you go through the years and hopefully your nest egg will grow, clearly then, as you talked about earlier, you might look at something a little bit more risky down the track. But as you also know, switching in and out of funds is also costly. There is the switching fee involved. possibly a sales fee up front and all of these other charges. Earlier on, Professor Ho talked about 0.3%. Apart from ETFs, I'm not sure any other investment that offers such a low management rate. How much are Aberdeen funds? 1.25, 1.5 a year, thereabouts. So what are some of the other things that our guests here today need to look out for when it comes to investing their money?
Well, that's a good question. I think when you talk about switching in and out of funds, changing your decision a lot, it comes back to my earlier point. I think the point that we've all made on this panel is the need for process, the need for terms of reference, the need for a clear investment management agreement with your manager and also within the committee itself, that you've said that you've got X dollar surplus funds and that you've decided that you want to allocate, let's say 50% equities, 50% fixed income, for example, because that's your risk tolerance, then really it's incumbent on the investment committee to stick the course with those fund managers, be it 1 or 2 years, and not look at the markets every single day and say, Christ, the market's down, what should we do? Or the market's up, let's lock in some gain. Because the more of those tradings and switching you do, it's a drag on fees. So there is volatility that's inherent in the markets, and there's cost drags in fees as well. Now, there's a fee to managing money by an external fund manager. That's the nature of the beast. It's difficult to find someone to manage your money for free. There is a fee. I think, obviously, working for a fund manager, I have one perspective, but if a fund manager is doing a good job protecting your capital, growing your capital in line with the investment management agreement, maintaining the purchasing power of your surplus reserves, then paying a fee is entirely defensible. If you are switching between funds because one fund has underperformed another fund for the last month and you're switching between Aberdeen to BlackRock to whatever, and you're paying your withdrawal fee and your front end load as well, then that's more challenging to defend to your trustees, for example.
I think I just one question to add. You mentioned about volatility and switching. I think the question for the investment committee would be tough when the funds is not performing for a few years and you have to make a decision or whether you're going to continue or you're going to switch. I think that will be important decision at some point in time an investment committee may have to make. I think going on the point about volatility and risk, I think generally we all know that if you want better returns, you end up having to accept higher risk and volatility. So I think conceptually, we got to go back as a charity, really. How much of volatility and risk do you want to accept? I think fundamentally, if you are doing the work that you're trying to do is to serve the sector, serve the community, you got to be aware that you should not accept so much volatility and risk. If someone else within the organization say higher volatility and risk, I think, to me, I find it just incongruent with the purpose of serving. That means it's better off, why don't you just pass your funds to someone else? Because you are exposing the organization and yourself to far higher risk that is required to serve the community. Yeah.
Okay, we're running desperately short of time once again. So final comments, please, starting with Professor Ho.
Well, I guess I fully understand the charity sector is challenging, but I always have to say that I think in Singapore we are relatively privileged. We have a very supportive government. And I think the community, we have a very generous community. I think the community do identifies and understands many of your good works that are done. I think the important thing is for charity to continue to do the good works. I am very clear in my mind. Once you have the good works done, the money will follow. But the moment we start worrying about only money, then it will hinder our good works. And more important than that, it draws our thoughts and energy away from the good works that we're doing.
All right. Master, not slave. Hao Yao, 20 seconds. Final words.
Well, I think that it's good that we're here talking about this topic, and it's something that I think a lot of charities will have to think about. The low interest rate environment may continue. Negative interest rates already exist in the financial world and may come down to this part of the world as well, or at least near zero interest rates. You still have to protect yourself against inflation. So this is something that your board may want to start thinking about, right? And of course, you will then find the right time to go about investing your funds if that's what you want.
Thank you. David, parting shots.
Not much new to add. All I would say is stress again, as we've heard, get the budgeting right, determine your surplus, get the right people to either serve on the investment committee or advisor committee, determine what kind of performance you want. Do you want to protect the principal or do you want to preserve your spending power? Set the parameters for your external fund managers if you do put it externally, and then don't panic. There will be some volatility if you put it into financial markets. Do not panic. Do not, as we say, cut at the point of maximum pain, because if you cut at the point of maximum pain when you're down 40% as we were in 2009, then as Hao-Ya said, it's very challenging to recover. If you, however, you'd put more money in 2009, if you have that luxury, of course, then the rewards can be there, but it's a challenging mindset to have.
Thank you, Marcus.
Okay, I only have 10 seconds. To me, only two advice really: start from the board. The board got to start the discussion. Find the right people. Find the right people that believe in the cause that can help you. Thank you.
Thank you. And within 10 seconds, before you rush out the door, you have until 2 o'clock, so you've got enough time to go to the washroom and go for lunch. I would like to invite Mr. Girardi to join us once again to present tokens of appreciation to our panelists. And I need to give you some other pointers for the rest of this afternoon. My thanks to Professor Ho Yuki, Mr. Ng Hao-Ya, Dr. David Smith, and Mr. Marcus Lam. Please give them a warm hand, ladies and gentlemen. While that's going on here on stage and our guests stay for a group photo, a couple of quick points in case you missed them this morning. Please take everything with you. Do not leave your goodie bags, your laptops, iPads, notepads, or anything else. These rooms will be turned around for the afternoon sessions. If you leave things, they will disappear. Please be back from lunch by 2 p.m. when the afternoon sessions start. Lunch is served just outside. If the queue is too long, go down the stairs, turn right to the Grange room, where there's also a separate buffet, just to make sure that everybody gets their turn. Please be in your respective workshop groups when you come back at 2 p.m. and slides and videos will be uploaded to the Charity Council website and will be emailed to you after the event. Give us about 1 or 2 weeks. See you at 2 o'clock.